Welcome to a presentation in financial management. Our focus of attention today is a build-up on the earlier presentation which we had, where we looked at the net present value as an investment appraisal technique. Today, we are going to look at another investment appraisal technique referred to as the internal rate of return. So from the outset, I've made it clear what we are actually trying to look at is another investment appraisal technique. I'm your presenter, Berman Kauseni. Let us try to appreciate the definition of investment rate of return. What is investment rate of return as an investment appraisal method? Internal rate of return is an investment appraisal technique which can be used to evaluate projects which a business might intend to undertake. So this investment appraisal technique basically determines the discount rate where the net present value equals 0. On top of that, it is important that we acknowledge that the internal rate of return aids in making a decision if a project should be undertaken or not undertaken. Let us now try to understand the net present value and the internal rate of return. We shall begin by focusing our attention firstly on the net present value. Thereafter, we shall proceed and look at the internal rate of return. So let's get to the net present value as an investment appraisal technique. Now, when we're looking at the NPV, the present value of benefits is less than or is less or minus the present value of costs, which are essentially discounted at a target rate, also known as the cost of capital. Let us move on and look at the internal rate of return, IRR. Now, under the internal rate of return, the exact discount rate that results in an NPV of 0. Internal rate of return is essentially the exact discount rate that is as a result in an NPV of 0. Now, if the internal rate of return is greater than the target rate, the project is said to be viable and it can be undertaken. Usually, it is worth taking note that risk in this circumstance can be ignored. Now, we move on to how the internal rate of return can be calculated. Now, there are a number of steps which we need to conform to or adhere to as we are trying to compute the internal rate of return. Step number 1. Under step number 1, we are required to calculate the NPV by using the company's cost of capital. Secondly, we are supposed to choose a second discount rate. Now, if the net present value is positive, we are supposed to use a higher discount rate. Alternatively, if the net present value is negative, we are supposed to use a lower discount rate. Under step 3, what we are required to do as we proceed to look at how we can compute the internal rate of return, we need to estimate the internal rate of return by using what can be referred to as interpolation. Now, let us now try to look at the formula which we can use as we try to compute the internal rate of return. So the internal rate of return is equal to R1 plus net present value 1 divided by net present value 1 minus net present value 2 multiplied by R2 minus R1. Now let's just try to understand this formula in depth. So it's important for us to realize or to be mindful that R1 is simply the lower discount rate and R2 is the higher discount rate. NPV1 is equal to NPV at R1 and NPV2 is equal to NPV at R2. Now, let us try to look at the practical application of the internal rate of return. Now, the internal rate of return can be used to evaluate projects which a business intends to undertake. Now, it is important that we compare the internal rate of return to the target rate of return. Now, if the internal rate of return exceeds the target rate, the project can be accepted. Now, we have come to the conclusion of this very short presentation, as we are going to look at another presentation upon which we are going to build upon what we have just gone through in this presentation. Now, it is worth acknowledging that the internal rate of return is a key financial metric which can be used in investment appraisal. This investment appraisal technique tries to help us in determining the viability of projects. Okay, so now, again, it is important to take note that interpolation method is useful when computational computational tools are not available as we strive to compute the internal rate of return. So at this particular juncture, I would like to thank you for your attention and time, but look out for another presentation where we're going to look at a practical example in trying to calculate the internal rate of return. So we should be able to use what we have gotten from this presentation in attempting the example which we are going to look at in the next presentation. Bye for now.